policy release day for the FOMC, and guess what? The market doesn't know what to make of the reaction. So I anticipated this. I actually got out of my bicycle and did 13 miles this morning, did something productive. Okay, on to something more productive. I get asked all the time about the whale trade, since we've been talking about the whale trade so much recently, because it's the one strategy that just seems to fit what this market wants to do, which is these limited risk, small trades that don't put a whole lot of risk capital out there. And if the market falls to pieces tomorrow, we're not going to lose any sleep over it. Right? So I get asked all the time with that in mind is what happens if the market does roll over? Does the whale trade work in reverse? Well, let me first say that you can't take a bullish strategy and just flip it upside down and trade it, because markets operate very, very differently on the way down. And you can just see this. This is Mattel, and Mattel has been taking the stairs up and has been taking the window down. And so what we do is, it's the old analogy, buy the dips and sell the rips. So buy the dips means when the market is trending higher, you're looking for any dip, a measurable dip against a trend line or a 7-day low or whatever type of strategy that you're trading, you buy the dips and you hold it long and you go for your measured exit. But when the market rolls over, what you don't want to do is to jump on board a market which is trending down. You've got to be positioned correctly before that, because not only does the implied volatility rocket higher, so that means that you're buying at the high in terms of implied volatility, but it's very, very difficult to jump on board these. They go very, very quickly. And usually you end up selling the low, and then it rallies from there, and this is what causes all that short covering. So bear market rallies or corrective rallies can be extremely sharp and short, right? So this is what we want to do, is we want to anticipate these. We want to sell the rips. We want to sell the rips. And this is one that showed up for me on Mattel. We had a daily chart that was just going ballistic to the upside. Right, so there's a lot of short covering here. A lot of people jumped on board down here, and then all of a sudden something positive comes out, and all those people that got on board way too late in the party had to cover their shorts. Well, unless there's something fundamentally different about this stock, which is changing the polarity back up to an uptrend again, then this is a rip that we can sell. Now, technically, we're not selling things. We're setting up just debit put spreads or a bear put spread on these types of trades. So my signal for this is anything below 25 on the choppiness index shows an extraordinarily stretched chart and is very, very likely to pull back even to a fib retracement. And that's really all I need. Is I've got a target of about 28 on this one. And that'll be good for about 100% return. So I'm sitting very, very close to that right now. And that could be off in the next day or so here. So this is an example of what you can do using the same type of principles, but you're kind of flipping it upside down. But you have to sell the rips and not jump on board something that's already moving down. And that's it for today's Market Minute. Thanks for listening. We'll see you tomorrow.